Hello everyone, this is Sebastian McMahon from IA Financial Group, and here's the review for the week ending March 1st, 2024. Looking at the markets after 2 months, we're just starting a new month here. It's all about tech again. Nasdaq up 10% on the year. S&P 500 just closed behind. After that, you have EFI, so Europe and Asia, 5%. Emerging markets and the TSX at about 2.5. Negative for bonds for the year, about 10% return on the price of oil. Gold going nowhere, but having an interesting momentum this week of 0.4%. So lots of things are happening here, but again, it's still all about tech for now. Big picture, this is where I thought I would go this week because next week will be spring break in Quebec City, so I'll be off next week, so there won't be a review on March 8th. The next one will be on March 15th, so I thought I would look at the big picture with you to get a good sense of where we're standing after 2 months. So the first one here, these are the economic surprises. The economic surprise indices, you have the gray line first, which is for the world. So surprises are positive. So that means that overall, the global data that comes out beats expectations of the surveyed economists. So that's good. There was an interesting upward trend recently. Of course, this is influenced a lot by what's going on in the US, which is the blue line on top. So economic surprises have been pretty good year to date in the US. We're seeing some good macro momentum emerging here. Maybe we've lost some steam recently, but we're still beating expectations. So that's good news. So if you have good macro news like that, good macro surprises, there are some reasons behind that. And one of those reasons is that we're starting to see monetary policy ease. We're not seeing it from the Fed, we're not seeing it from the ECB or the Bank of Canada, but in emerging markets, this is the chart on the left here, we're starting to see net cuts. So central banks in the last 3 months, there's more that are cutting than those that are not doing anything or hiking. So we're starting to see some air being blown on the economy. So a breath of fresh air. This is good. For developed markets, we are not seeing net cuts yet. Of course, we're looking at the Bank of Canada, we're looking at the Fed, the ECB. We know that rate cuts are coming, but they're not there yet. So there's this that is helping, sustaining this momentum in the short run. On the right, you see that the percentage of countries where you're seeing an acceleration or growth in manufacturing, so the manufacturing PMIs are above 50, so this is a diffusion index. On the right, you're seeing that now we're just crossed the line of 40%, so there's more and more countries that are seeing some growth. So again, another sign that we've bottoming process and we're re-accelerating here. So good news on the macro front, but of course, for central banks, if you're fighting inflation and economic news are getting better and better, that might bring some more inflationary pressures, and that could create some volatility in the expectations towards central banks for the rest of the year. So the question that we ask this week is, have we reached, quote, peak disinflation? So if you look at the chart on the left, this is PCE inflation. This is what we had coming out last week from the US. There's multiple components here, but first the picture is that inflation is slowing down. We already knew that. The components here, if you look at the lighter shade of blue, the sticks that were on top for the last few months around the peak, let me just zoom in here for 2022, it had a strong impact. It was inflation coming from non-durable goods. For of course, everything that happened with the pandemic and the inflation in goods, the disinflation there has mostly happened. Now this is close to zero year over year, the contribution from this factor. Now, when you look forward, you see, well, the potential for maybe some reflation on goods based on shipping costs, based on dwindling inventory. So there's risks that we could see an uptick in inflation in goods, or at least we can say it another way. Maybe the disinflation coming from goods has run its course. So that's a risk. But of course, what sticks out in this chart are the, let's say, the purple sticks, which is inflation coming from services. And inflation from services, of course, the chart on the right shows that it is tightly linked to wage growth and wage pressures. And what you see is that median wage growth remains elevated, meaning that it carried services CPI with it. So we are seeing a disinflation in wages, which is happening slowly. So you can see good news there. But if we go to the next slide, what you see is that the leading indicator of wage growth are starting to turn higher. And here's a good example here. This is the NFIB, so Small Business Association in the US. They have a survey that comes out every month, and these are the compensation plans for the next 3 months. This is the blue line, and it leads wage growth by 6 months in this chart here. So as you can see, it did lead wage growth in 2021 and 2022. Businesses were looking forward and thinking that they had to raise wages. That fell down a little bit, but now we're starting to see another uptick from that. So it is a risk. It is one leading indicator. Let's see what happens. But the question that we're asking here is, the disinflationary forces that we've been dealing with for the last 12 to 18 months, are they starting to fade, and are we at risk of seeing reacceleration of inflation? And if so, what will happen with monetary policy? We're starting to see some people extend their neck out there, investment firms claiming that they think that we might see more rate hikes from the Fed, or at least no cuts in 2024. We still think that if the story happens the way that we expect it to happen, we might see some cuts by the end of the year, maybe 2 or 3. But let's say if we're still looking at those charts during the crunch of the summer, late summer, and we still see inflation sticking around, the odds will be rising that maybe cuts will be coming, but more in 2025. So still a big question mark. The disinflationary forces at work here are at risk of slowing down quite sharply over the next month or so. So that wraps it up for the week. What to watch next week? I won't be there to comment on these on these news, but Bank of Canada rate decision. No change is expected. Consensus is pretty wide. We still think July makes sense, but we're gonna fall off our chair if it happened before, but very likely not next week in March. So no change is expected by us and by consensus. Employment reports will be out on both sides of the border. 20,000 jobs in Canada. Unemployment rate rising at 5.8%. So we would still not be creating jobs fast enough to accommodate the growth in population. In the US, ISM services still in growth territory, but slowing down a little bit. And the non-farm payroll, we had a blowout report in January, about 300,000 plus. It should be lower at 119 February, and the unemployment rate should go sideways at 3.7%. So if you want to reach us, ia.ca/economy for the review, the podcast, iagam.ca/insights for the keys to the market weekly piece, the monthly macro strategy and insights. So there's a lot of material for everyone. Always a pleasure to serve you. Again, I won't be here next week. Next edition will be on March 15. So enjoy the first few weeks of March, or let's say the last few weeks of winter. I'll be back again in 2 weeks.